Thank you, Mr. Chairman. I know that you have to be careful in the terms you use, and in particular of using terms that might become self-fulfilling prophecies. But as you look at all of these dire conditions and the recent events that I described just earlier, how does the Fed sum it up? What's the Fed's overall diagnosis of the course of the economy over the next year to 18 months?
Well, we currently see the economy as continuing to grow, but growing at a relatively slow pace, particularly in the first half of this year. As the housing contraction begins to wane, as it should sometime during this year, the economy should pick up a bit later in this year. But we believe we'll see below-trend growth, certainly in 2008 and probably early into 2009 as well.
You indicate in your testimony that conditions appear to be worsening in 2008?
Yes. The latter half of 2007 was actually reasonably good. The third quarter, we saw growth of about 5%. Growth slowed significantly in the fourth quarter, but is still moderate. Recent indications suggest, though, that the economy has softened somewhat and that the growth prospects for 2008 are certainly below that of last year.
But as I listen to you read the first several pages of your testimony describing the conditions in the financial markets in particular, the swollen, non-conforming mortgage portfolios, the lack of investor confidence in the valuation of their investments, then the lack of confidence in institutions holding those assets, a long litany of fairly distinct and unique problems, doesn't appear to be your garden variety business cycle recession of the kind we were used to in the years after the end of the last war.
Well, again, we're not forecasting recession, but rather at this point slow growth. But you're absolutely correct, Mr. Chairman, that there are a number of characteristics of this period that are somewhat unique, including the financial market turmoil we've seen, pressures on the banks. We are hit on the other side by these rapid increases in oil and commodity prices, which create some inflation risk and create a problem on that side. The housing sector, of course, has been in a very sharp contraction and relatively unusual pattern that we've seen there as well. So there really is a confluence of different events that makes this a difficult combination of circumstances. I think it's important as we are concerned about the slowing growth of the economy that the U.S. economy remains extraordinarily resilient. It's very diversified. It has strong labor force, excellent productivity and technology, and a deep and liquid financial market that is in the process of trying to repair itself. So I think we need to keep in mind also that the economy does have inherent strengths and that those will certainly surface over a period of time.
Would you agree that the confluence, as you put it, of these dire events calls for something broader than monetary policy and gives us a particular reason for using a fiscal policy stimulus in this particular set of circumstances?
As I said, Mr. Chairman, I think a fiscal stimulus package could be helpful in the current circumstances. It would provide a broader base of support to the economy than just that afforded by monetary policy. It would, in some sense, diversify our policy tools as we attempt to address the situation, and might have somewhat different timing, different effects on the economy than monetary policy. So I think it could be helpful, but as I emphasized in my testimony, it needs to be done quickly, to be temporary, and to have be effective in the sense that for every dollar put into stimulus, we get a reasonable response in terms of extra activity during the next year or so.
Given these structural problems in the financial markets, do you think that a fiscal policy solution or package should go to the source of the problem, as you put it, where the existing events were triggered, and attempt some sort of structural fix, as well as providing some aggregate demand increases?
Well, there are a whole range of issues that we'll be looking at over the next couple of years. In the financial markets, we'll be wanting to review whether regulatory and accounting policies need to be changed in light of what we've seen in the last couple of years. I'm sure there'll be continued attention to the housing market and mortgage market and the issues that were raised in the recent experience there. But I think from the perspective of fiscal stimulus, if we're able to provide some additional strength in the near term in the economy, that will be beneficial broadly. For example, if the economy is growing more quickly, then the stresses on the housing market, on the financial market, would be correspondingly reduced.
Could you take just a second and explain to us how it is that a problem so pervasive and so serious was able to crop up or arrive under the radar without being detected sooner by the regulators?
Well, there was, as I said, there was a combination of factors. The economy was reaching its full employment point a couple of years ago, and the Federal Reserve was very focused on trying to help the economy go along an expansion path without inflation. We were very focused on that. But we have, just as I said, a confluence of factors. One of the key factors has been the housing boom and bust that we've seen. House prices and house construction are obviously on the downtrend. That in turn has interacted with mortgage markets, and particularly subprime mortgages, as I've discussed, and created, particularly in the category of subprime mortgages with adjustable rates, has created high rates of delinquency. That in turn has fed into the financial system and created pressures in the banking sector, which are then being felt in terms of their profitability, their capital, and their willingness to extend credit. So it's been a complicated interaction of factors that have led to this situation.
Has the prevalence of securitized mortgage packages made it more difficult to find a regulatory solution to the problems in the financial market?
In some respects it has. Mortgages are no longer generally held by the lender who made the mortgage. Instead, the mortgages have been sliced and diced and sold throughout the financial system as part of structured credit products or as part of mortgage-backed securities. We have found some complexity arising from that in terms of loan modifications and workouts. It's somewhat more difficult for the servicer to work out a loan with a troubled borrower when the servicer doesn't own the mortgage and has to essentially meet the requirements and the interests of all the holders of the mortgage. We at the Federal Reserve, along with the other regulators, have been working hard trying to find solutions to that. We have tried to address technical problems such as accounting rules that might impede servicers from modifying loans. We have provided letters of encouragement essentially to servicers and to banks, encouraging them to do loan modifications wherever feasible. Of course, the Treasury and the HUD have undertaken this Hope Now initiative to try to increase the scale and scope of renegotiation and loan modifications. So there are many efforts underway to try and increase the scale and to address more effectively the problem of troubled borrowers.